I recently interviewed Janetta McKenzie, director of the oil and gas program at Pembina Institute, and her colleague Megan Gordon, who is the manager of Equitable Transition, about a new report that they co-authored. It's titled Drilling Down Oil and Gas Jobs in Transition. And in this clip, I'm talking to Janetta about some of the structural reasons why oil and gas employment in Canada has fallen, even though production has rocketed over the last 10 years. And Janetta, I confess, I spend most of my time thinking about this issue in terms of Alberta because it's just simply the biggest employment generator. It's where most of the oil that gets produced in Canada. So you can maybe jump in with, comments on Saskatchewan or Newfoundland and Labrador. But everything started with the price crash of late 2014. Maybe you want to explain that.
Yeah, so what really got us interested in this sort of report that looks at oil and gas jobs in Canada? It does look at Canadian jobs, but obviously a lot of these trends are very, very alive in Alberta. Is we thought that this price crash had maybe been the impetus for firms to really start behaving differently on a sort of in a fundamental way. And we found when we started looking at the kind of job trends that appeared to be true. We've seen production and profits go up quite a bit in the sector since 2013, 2014, especially in the post-COVID kind of boom since 2021. But the jobs sort of per barrel or per BCF of natural gas have gone down. We have fewer workers working to produce more gas or oil. So we think that's kind of an interesting trend to pick up on, especially as right now provincial and federal governments are thinking about what major infrastructure projects they want to prioritize, how they want to build resilience into the Canadian economy. Just the package of benefits of major fossil fuel infrastructure has really, we think, changed since 2014 because firms are just behaving very differently now.
A couple of years ago, I interviewed a Texas economist who tracks this information, and he said they're seeing exactly the same trends in the Texas oil and gas industry. It's just this is now, I mean, this industry is 125 years old, but the new technologies like fracking and multilateral wells or the oil sands, it is now much more mature than it was, 2014, and companies are able to squeeze efficiencies out of their operations. And let's talk about some of the ways that they do that because, there's automated well monitoring, for example. Nobody drives around, you don't have pumpers anymore driving around to leases. And that has just, the idea of new technologies just permeated the industry, hasn't it?
It has. And in the last 10 years, there's been a real focus on some marginal expansions at existing facilities rather than a lot of big new investment in large new greenfield sites. So that type of behavior plus cost cutting on sites, automation where possible, which you mentioned, Markham. Another example is the deployment of autonomous mining trucks, which we've seen at several oil sands facilities. Mergers and acquisitions as well often prompt firms to find economies of scale when they acquire smaller companies. There's also been this trend, which we've analyzed before, of firms really focusing on returning capital to shareholders and shareholder returns rather than a lot of new capital expenditures, particularly in the oil sands. Certainly, there's still expenditures happening. There's still a focus on expansion at existing facilities, but there's just really not a focus on the type of really big greenfield investments that would prompt a lot of new jobs. And there is a focus on cost cutting, workforce reduction, automation, wherever we can find it. And of course, the rise of AI will probably accelerate those trends as well. I think it's fair to say.
Let's talk about some numbers for a minute. Oil and gas investment in Alberta peaked in 2014 at about $80 billion. And out of that, the CapEx for conventional oil and gas really hasn't changed much. It's 20 billion, 22 billion, that's drilling wells and servicing and all of that. It's the oil sands where the CapEx has really plummeted. And that's just a function of the nature of the business. It's not like conventional oil. It's more like manufacturing, right? And so you have to build all this plant and you have to build infrastructure like roads and transmission lines, whatever it is, but you have to build that up front, spend your money, and then when you operate, then you need much less capital, and that really has lowered the capex that's spent every year quite substantially.
Yeah, exactly. Especially with oil sands and with conventional oil and gas production, there is a sort of trend of, new wells needing to be drilled while other wells are retired or taken out of service relatively consistently. But overall, like these capital expenditure trends combined with the fact that production does continue to increase and jobs per barrel or per barrel equivalent continue to go down does really speak to the sort of the decoupling of production and profits and jobs. This is a sector that's doesn't isn't really behaving like it's gearing up for several decades of massive expansion. They're behaving like companies that are really focused on minimizing costs, maximizing profits, and expansions at existing facilities.